Welcome back to Tesla Daily News Podcast. Today is Thursday, February 26th, 2026. In the next few minutes, we're breaking down the biggest Tesla headlines that could move sentiment and, ultimately, the stock, autonomy progress and regulation risk, Europe demand weakness, new Cybertruck pricing, Tesla's semi-charging build-out, and a major energy supply shift tied to tariffs and U.S. sourcing. Story 1. Tesla's Cybercab just took a big step from concept to hardware, and the market noticed. The hook here is simple. Tesla shares popped about 2.4% Tuesday to around $409 after reports that the first Cybercab production unit rolled off the line at Gigafactory, Texas, roughly 2 months ahead of the prior expected timing. Context: a meaningful chunk of Tesla's valuation is tied to autonomy, robotaxi revenue, and software-like margins. Anything that signals forward motion on a purpose-built robotaxi platform can boost investor confidence, even if commercial rollout is still far away. Details: Cybercab is described as a fully autonomous vehicle design with no steering wheel and no pedals. That's not just a styling choice. It implies Tesla is aiming for a vehicle that only makes sense if regulators approve true driverless operation. Impact: near term, an early production milestone can help narrative momentum and keep the autonomy story front and center for analysts. But it also raises the key question. Hardware progress is one thing, regulatory approval and safety validation are another. If Tesla can't get broad approvals, Cybercab becomes a capex-heavy product with constrained monetization. Takeaway: for investors, treat first unit off the line as a progress data point, not a revenue inflection. The bigger catalysts will be regulatory permissions, geofence service launches, safety data transparency, and unit economics once a paid service begins. Story 2. Tesla is escalating its fight with regulators over what it can call Autopilot and Full Self-Driving. Hook: Tesla is suing the California DMV to overturn a ruling that found Tesla's marketing around Autopilot and Full Self-Driving to be false advertising, even after Tesla made some wording changes. Context: Tesla's FSD narrative is central to subscription revenue, take rate assumptions, and the software company multiple money bulls argue for. Branding restrictions or adverse rulings can hit demand, increase legal exposure, and pressure margins if features must be repositioned as purely driver assistance. Details: coverage points to a long-running back and forth, with the DMV pushing Tesla to avoid language implying the car can drive itself when it is legally considered driver assistance. Tesla's lawsuit argues the restriction is unconstitutional. Impact: this is a double-edged sword. If Tesla wins, it preserves marketing flexibility and may support FSD subscription growth. If Tesla loses, it can increase scrutiny nationally and globally, potentially impacting take rates, consumer trust, and even the long-run robotaxi thesis. Takeaway: watch this like an investor watches an FDA process. It's not just PR. Words on the window sticker can become constraints on growth, and legal precedent in California tends to echo beyond one state. Story 3. Europe is a pressure point, and January numbers suggest Tesla's slump is deepening. Hook: Tesla registrations in Europe fell for the 13th straight month, with January registrations down about 17% year-over-year to roughly 8,075 units. Context: Europe has been a major EV profit pool and a key region for brand strength. But it's also now the most competitive battlefield, with aggressive Chinese pricing and strong local options. Details: multiple reports cite the broader European market being down around 3.5% in January, while Tesla's decline is much steeper. Meanwhile, BYD registrations jumped sharply, with figures cited around 18,242 units, up about 165% year-over-year. That shift translated into BYD having a larger market share than Tesla in the cited month. Impact: sustained weakness in Europe matters because it can force pricing actions, and pricing actions usually flow straight into automotive gross margin compression. It can also shift the narrative from temporary model changeover to structural market share loss, which affects analyst models for 2026 deliveries. Takeaway: the next thing to watch is whether Tesla responds with targeted incentives, fresh trims like a longer Model Y variant in more markets, or manufacturing cost reductions to defend margin while competing on price. Story 4. Tesla just rolled out a cheaper Cybertruck variant, and it changes the demand conversation. Hook: Tesla introduced a new Cybertruck all-wheel drive priced at about $59,990, with a stated range around 325 miles. Context: Cybertruck has been a visibility product for Tesla, but pricing and production complexity have been key debates. A lower-priced trim can broaden the addressable market and potentially improve order flow, especially if early adopters have already been served. Details. Coverage notes this is a new configuration positioned below prior trims and that it's available now through Tesla's ordering system. Impact. The bullish read is that Tesla is moving down the price curve, which can help volume and factory utilization. The cautious read is that price step-downs can signal demand elasticity issues, and if costs do not fall as fast as price, gross margin will take the hit. Investors should also look for whether this trim implies simpler manufacturing or just lower content. Takeaway. The number to watch isn't just the sticker price. It's delivery wait times, estimated production ramp, and whether Tesla can maintain healthy gross margins as it expands the mix. Story 5. Tesla's semi-ecosystem just got more real, with 64 new Megacharger sites added to the map. Hook. Tesla updated its Find Us map with 64 new Megacharger locations across 15 states. Combined with existing sites, that puts the map at about 66 total locations. Context. The Semi isn't just a truck, it's a logistics platform. Without a reliable high-power charging network, fleet buyers can't operationalize total cost of ownership savings. Details. These megachargers are designed to support heavy-duty charging needs and create defined trucking corridors. Impact. This is incremental but important. It lowers a key adoption barrier and can help Tesla compete in commercial fleets where uptime and route certainty matter more than consumer convenience. Over time, it also strengthens the case that Tesla energy and charging infrastructure are strategic moats, not side projects. Takeaway. Watch for customer announcements and deployment scale. Infrastructure progress is necessary, but revenue shows up when large fleets sign and Semi ship in volume. Story 6. Tesla's energy business may be reshaping its supply chain to reduce China exposure, and that has margin and growth implications. Hook. A report says Tesla is moving away from Chinese-made Megapack battery cells for products sold in the United States, tied to a contract described at around $4 billion, aiming to use American-made cells. Context. Tariffs, import restrictions, and geopolitical risk can directly impact cost of goods sold for energy storage. Megapack demand has been strong industry-wide, but supply chain constraints and eligibility for domestic content incentives can swing project economics. Details. The claim is that Tesla is repositioning cell sourcing so U.S. Megapacks qualify more cleanly for Made in America style requirements and to mitigate tariff risk. Impact. If executed well, this can stabilize supply and de-risk costs, supporting growth in grid storage deployments. However, domestic sourcing can also be more expensive at first, potentially pressuring margin until scale improves. Takeaway. Investors should watch Tesla Energy gross margin trends and backlog commentary. Megapack is increasingly important to Tesla's diversification, especially when vehicle demand is choppy in certain regions. One more risk item to keep on the radar. Tesla is facing more legal scrutiny on multiple fronts. A U.S. judge refused to dismiss a lawsuit alleging Tesla discriminated against American citizens in hiring to pay less to foreign workers, though the judge said he was skeptical the plaintiff would ultimately prevail. Separately, ongoing Autopilot-related litigation continues to create headline risk, including references and coverage to a $243 million judgment in a wrongful death case tied to Autopilot claims. The investor lens. Legal costs usually aren't the issue for Tesla. The risk is brand trust, regulatory tightening, and constraints on how autonomy is sold and deployed. That's it for today's Tesla Daily News podcast. Recap. Cybercab production progress is fueling the autonomy narrative, but regulation remains the gating item. Europe demand is still sliding as competition intensifies. Cybertruck is moving to a lower price point that could support volume but challenges margin optics. The Semi Megacharger rollout signals infrastructure commitment. And Tesla energy supply chain shifts could reduce tariff exposure, but will be judged by margins and delivery cadence. For tomorrow, watch for any follow-up on Cybercab regulatory pathways, fresh Europe registration data, and any official Tesla commentary that clarifies pricing strategy and margin direction. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for a fast, data-driven update every market day.